All right, you should be getting a pop-up on your screen. And again, if you want to not be on video, just feel free to kill the video feed and please mute your phones or your computer if you're not speaking. So let's start with antitrust statement. As participants in this meeting, we need to be mindful of the constraints of antitrust law. There should be no discussion of agreements or concerted actions that may restrain competition. And this prohibition includes the exchange of information concerning individual prices, rates, coverages, market practices, claim settlement practices, or any other competitive aspects of an individual's company operation. Each participant is obligated to speak up immediately for the purpose of preventing any discussion falling outside these bounds. So I don't think we had this happen before, but if you hear something you don't like, just raise your hand or just interrupt the call and we'll redirect the conversation as appropriate. So today is my pleasure to have back Eric. So I checked, Eric, and you were with us last time in February of 2021. It was just immediately after the inauguration, and you made a number of predictions on what was going to happen. And you told us, hey, keep an eye on the FTC and the CFPB and anything that is related to fair lending and in general consumer risk. Keep in mind that that's something of importance. So I would do a disservice introducing you. I know that every time you write an article, I'm really eager to read it. You're one of the most authoritative voices out there. I always follow what you do as much as I can. Would you mind introducing yourself to this audience? And then let's dig into the topics for today.
Sure, you bet. Well, I appreciate you having me back. So I either did a good job last time, or it's kind of like moving. You know, you forget how bad it was the last time you moved, and this next time, you know, you don't have memory of that. So hopefully it was the former. But I'm a partner with Hudson Cook in our Oklahoma City office, and been here about 9 years as a partner with the firm. My primary focus is in auto finance, although I work with many different clients, from mortgage to other, you know, DMS providers, et cetera. But I tend to focus more on auto finance, and particularly related to state law issues for Oklahoma issues, but also federal law issues like our friends at the CFPB and the Federal Trade Commission. Been around and watching them since they were, you know, the first came on in an infancy, and have been watching them grow from Cordray's era to Craniger to now what I call the CFPB 3.0. So I'll be talking about, I guess, the CFPB and what they've been up to here lately, as well as what our friends at the Federal Trade Commission have been up to lately, and hopefully be able to point out some of my thoughts on some of the trends and directions that I see both agencies going, and some things to look for and to be concerned about, you know, as we head into the second part of 2022.
Well, thank you, Eric. And I know that you sent me this list of bullet points of, would it be all right if I covered this stuff? And I think that people in the audience will say, yes. That's relevant, of course, to the members of IARA. And so if you don't mind, I'll just give the microphone to you, and I'll let you go and talk through whatever you think are, you know, go through this agenda or whatever else you think would be a good place. And we'll make sure we carve out the next 10 minutes for Q&A. And I'll keep watching the queue of people that are still coming into the call. Thank you, Eric.
Great, you bet. Yeah, I think that's, and I just went through primarily this outline. There was a new update today, a new advisory opinion from the Bureau that I'll talk about just briefly. But I think the first thing is first thing I want to tackle is not on this list, but the Bureau's activity related to what they call so-called illegal repossessions. Back at the end of February, the Bureau announced that they were moving to thwart so-called illegal repos in the kind of the heated auto finance or auto market. And they had issued at that time a compliance bulletin that addressed repos and conduct that they observed either during their examinations, or maybe some of their enforcement actions going all the way back to, I think, October of 2020 with the Nissan enforcement action. where they were talking about what they consider an illegal seizure of a car, sloppy record keeping, unreliable account statements or balance statements, and what they have described as misappropriation of personal property that's left in the vehicle. Chopra at the time had said that with today's high car prices, auto lenders and investors might be tempted to seize vehicles for resale in the hot used car market, and that auto loan servicers need to make sure that every repo that they conduct is in fact lawful. And that drew quite the ire from some of the members of the House Financial Services Committee. They actually sent him a letter right after his statements and his blog post saying that equating repossessing a vehicle with theft as a gross mischaracterization, and they posed various questions to the director at the time. See, the Bureau is concerned that because of the prices of used cars and the strong demand for used cars because of the chip shortage for the new vehicles, et cetera, they are concerned about whether that can create some sort of incentive to go out and repossess a vehicle because it would demand a higher price whenever the vehicle is resold. I think faulty premise, but that's certainly what the Bureau has stated. In their bulletin, however, they summarize the current law as they see it, and they indicated that certain activities are considered a UDAAP, unfair, deceptive, or abusive act or practice. And they give different examples of those that I'll go through briefly. And they give a whole long laundry list or bullet point of some of their exceptions or expectations, rather, what the Bureau expects you to do or rather not do if you're going to repossess a vehicle. Some of the examples that they consider to be a UDAAP include, again, illegally seizing a car. They see it as borrowers have made payments that are sufficient to stop the repossession or have entered into a payment plan, but then the vehicle is repossessed. So again, they're saying if you're a servicer, you must ensure that every repossession is valid. Engaging in the sloppy record keeping, making sure that there's a proper communication between the servicer and any third party like a repossession forwarding company or a repossession agent that's actually repoing the vehicle. Providing the consumer with unreliable balance or account information. And again, they claim that some of these balances can lead to a borrower paying less than a sufficient amount to avoid the delinquency, and then that in turn results in a repossession. So they're saying servicers need to have reliable, accurate, timely account information to provide to consumers. Otherwise, it can lead to a repossession. And then lastly, the comment that they said was that either the repo agent or company was holding personal property that it's found in a vehicle, holding that property hostage pending a repayment of fees. And so they claimed that this practice is a UDAAP, and they said, we've really been cracking down on this activity, this type of practice for years. And then they touted the Nissan consent order, and they actually touted some of their supervisory highlights going all the way back to, I think it was the fall of 2016. These supervisory highlights, as you may know, since the examinations are confidential of entities, what they will issue is what they call a supervisory highlight that talks about what they reportedly found during their supervision and actions against somebody. So they actually touted that going all the way back to the fall of 2016. The Bureau stated that they were closely watching the auto lending market, and the bulletin was applicable as of March the 3rd. So that is currently in place. Again, good examples, I think, if you're repossessing a vehicle of what to do and rather what not to do, I think. Again, it's not going to be something that I think they're going to stop here. I think we're going to see continued interest by the Bureau on so-called illegal repossessions. In fact, the supervisory highlights that they issued just recently in May the 2nd, they also reported on different alleged violations. Now, this is for I think the latter part of 2021, which was July to December of last year. They looked at a whole wide range of activities from auto servicing to consumer reporting to credit cards, et cetera. So they, again, collapse it all into this one supervisory highlight. They talked about their recent compliance bulletin, and then they also talked about how some of the recent examinations, how they found that servicers were engaged in these UDAAPs again by repossessing vehicles, even after they claimed the consumers took actions to make sure that those repos would not occur. They found, again, they thought that certain servicers were engaged in unfairly failing to obtain refunds for borrowers for add-on products. They found that auto servicers misled consumers about the amount of their final loan payment after their payment was deferred based on the pandemic, et cetera. So again, not a lot of meat, I think, in their supervisor highlights, but again, it's another example of how they just keep going back to the well and really attacking these so-called illegal repos. So again, if you are involved in a repossession, make sure you have obviously the legal right to repossess, that your records are accurate, that you're providing accurate information to the consumer, and make sure that if you are approached to return personal property, that you comply with the best practices and that certainly that compliance bulletin that they had mentioned. Okay. So that's the first one, like not on the list. Unfair discrimination in consumer finance and UDAAPs.
Hey, Eric, before we move on, so a question for you. So,
sure.
First of all, I'm going to put my old business school hat on my head. And I think it's not unexpected that given the composition of both the CFPB and the FTC, and given the higher the historical returns that financial companies had, the higher level of attention of regulators is kind of expected.
Mm-hmm.
But there was a letter sent by about 10 elected officials that asked a number of questions on what kind of evidence do you have to support that? Was there an answer to that? And what is the actual evidence that the FTC, the CFPB is looking for? And I'm sorry if I say all the time FTC, because reality Chopra comes from, in my mind, I still call him Commissioner Chopra. So,
Right.
and there's clearly a history here, but I apologize for the confusion.
It's okay. Yeah, it's hard to make that switch. Yeah, you're right. I talked about the 11 members of the House. I guess it was the House Financial Services Committee sent director a letter. I think it was in February, end of February, I believe. I have not found a response from Chopra to that letter, and their demands for what evidence that he had that servicers or so-called lenders were engaged in this activity. But that's not that unusual. Many times, I know in the past, some of the members of the House or even the Senate had sent a letter to the director, and the director just did not respond. But I have not seen a response to this particular letter making demands for that information. But I do know that based on what the Bureau claims, I think a good example of what they reportedly found is set forth in the Nissan consent order. You can go through the consent order, at least look at the different allegations that they made against Nissan and about what the Bureau reportedly found about, like the consumer making a promise to pay and Nissan reportedly telling them, okay, we're not going to repossess the vehicle until that period for repayment is over. And then next thing you see is the Bureau claiming, well, Nissan didn't wait until that period was over and they went ahead and repossessed the vehicle. So there's not a lot that we can glean from what actually happened, other than to look, I think, at that consent order to see what the Bureau claims happened in part of their examination and part of their enforcement action. Does that answer your question?
Yeah, it does. Is there anybody here in the audience that has any questions on this topic before we move on to the next one? And you can also keep the questions at the end because we'll have a session on Q&A, so don't feel like you need to jump in, but I think it's good to have questions as the topics are still live.
Yeah, and it gives your speaker a break too. That's very much welcome.
You can grab a glass
there's no video on me because I'm getting eye surgery done, so I don't have any makeup on, and that's really scary. This is Jeannie Shermonte from that really big bank that everybody knows where I'm from, but I won't say what it is. But anyway, going back to, it was great the information that you provided us. Going back to the remark, repo agents and personal property and holding personal property storage. Can you expand on that, in that we know that there's state requirements of when they allegedly, quote unquote, can hold the car there because they can't get into the car, but is there such a thing that's state mandated, and where is that, those state mandates that say we can hold it for 60 days in the state of, I'm just throwing one out, Texas, I don't know, it's 60 days, until we're able to get in the car, which nowadays with repossessions, you can't, you don't have keys. Does that make sense what I'm asking?
I think so, kind of like the intersection between what state law either may require or may provide versus what the Bureau is looking at and what they claim.
Right.
Yeah, I mean, I think what this goes back to really is that what the Bureau claims is that the repo agents were basically, getting the personal property in the vehicle that was repossessed and holding it hostage and making the consumer pay a fee before those items would be released to the consumer.
Oh, right. Okay. Now I
and what,
remember.
and what the Bureau was doing is they were saying, all right, well, bank or finance company or servicer, you are liable for the actions of your agent. Your repo agent may be the ones charging the fee to the consumer, which the Bureau hates. They hate that. They say it's an unfair, deceptive, or abusive act or practice to do that. And then they key it back to the lender to say, well, it's your agent, therefore under our, some of our prior bulletins, they are your service provider, and therefore you are liable for their activities. So yeah, they engaged in a UDAAP, but so did you, because they are your agent.
All right, I get how that's referenced, and now we address that piece of it. I'm just kind of looking at a different perspective, but I get what you're saying, so I'm good. Thank you. I tried to give you a break, and then you had to talk again.
I appreciate it. As long as I get a break to get water, I'm good. So
there you go. All right, I'm good. Thank you. Appreciate it.
All right. Well, then I will go on to the next topic. Then the unfair discrimination. Now, this to me is really interesting. I don't know that we have seen all the effects of this, but the Bureau claims, they announced on March 16th that the discrimination, whether it's intentional or unintentional, but that produces a discriminatory outcome, is an unfair, deceptive, or abusive act or practice, or again, it's a UDAAP. So what the Bureau said is they are going to now target discrimination as an unfair practice, basically as a UDAAP, in connection with all financial products and services, and not just credit products. So think maybe a non-credit product might be, for example, like an ancillary product, like a service contract. It's not a credit product. It's more of a service, not necessarily tied to credit. But what they're saying is that they're going to look at discrimination as a UDAAP, even as to these non-credit products. And it's a major change in their philosophy than how they had looked at this before. And just like Andrea said, Chopra comes from the FTC, former FTC commissioner, but this idea that a practice could be discriminatory under a law like the Equal Credit Opportunity Act and unfair under other acts like the FTC Act, or say under their UDAAP authority, has been simmering around for a number of years. Chopra did note when he was a commissioner that this is a possibility. And so it seems like he's brought that mindset, that kind of new interpretation over to the Bureau from the FTC. Now, not only did they make this declaration, but they went a step further and they announced changes to their examination manual. in the examination manuals, basically it's like an instruction manual for the examiners and how they're supposed to go out and examine or audit someone that is a covered person, or a bank or other finance company that's subject to their supervision authority. But what they announced in their manual was that a change to evaluate how they look at UDAAPs, and instructed them to look beyond discrimination and look directly from, say, things that are directly connected to fair lending laws like the Equal Credit Opportunity Act, and instruct them to review any policies or procedures that either exclude individuals from products or services, or maybe you're offering a product or service to someone in an unfair, discriminatory matter. So that's a pretty big expansion of how they traditionally would look at things, where traditionally they're looking at something as discriminatory under, like, ECOA, Equal Credit Opportunity Act. It's either intentionally discriminatory or maybe has a disparate impact on somebody. But they're actually saying now to look beyond discrimination related to fair lending laws like they're typically doing. They also said under this new criteria, consumers can be harmed by discrimination regardless of whether it's intentional or not. And under this new theory, discrimination can now be unfair in cases where the conduct may also be covered by ECOA, as well as where fair lending laws like ECOA do not apply. Again, huge expansion of their authority. The Bureau said that they're going to look at a financial institution's decision-making in their advertising, in their pricing of products and services, as well as other areas like, traditionally, like from their extension of credit, but also how you service an account, how you collect, consumer reporting, payments, and deposits, to make sure that companies are testing for and eliminating so-called illegal discrimination. They're going to ask companies that are supervised to show their process for assessing risk and discriminatory outcomes, including how you document a customer's demographics and the impact of not only the products, but also the fees on these different demographic groups. And they're going to test and monitor companies' decision-making process for unfair discrimination, as well as discrimination under Equal Credit Opportunity Act. Along with this, it's kind of like a three-part approach, but they had the bulletin, they had the examination manual update. There was also a blog post from the Assistant Director for Enforcement and the Assistant Director for Supervision Policy and Examination. They had a blog post called Cracking Down on Discrimination in the Financial Sector. And they also talked about how they are going to be focused on companies' reliance on automated decision-making models, or the use of AI on potential discriminatory outcomes. That's another issue or area of concern that they have, is these kind of these black boxes where all this information goes into this black box, and what is outputted is a decision using these algorithms or AI to come up with a decision on whether to extend credit or not. So that's another area that they are focused on there. So
Eric,
maybe I'll stop there and ask and see if anybody has any questions.
Yeah, and actually, I'm glad you brought that up, because what I'm hearing from you, but I don't want to put words in your mouth, so I'd like to hear it from you. And by the way, we should tell everybody this is not legal advice. This is for informational purposes only. I will provide Eric's information at the end of the session in the slides, so you can contact him if you have questions directly. So this is not legal advice. But one thing that I think I heard, and that is common wisdom, is that the more process-oriented you are, and the more you have standards and you follow the process, whatever process you have set up to process whatever case, so that every consumer is treated in the same way, is traditionally looked as a good thing, until AI comes in. And me being the technical dork that I am, I also look at the bulletins from NIST, the National Institute for Science and Technology, and they recently published 2 publications on how to test for bias in AI, which is very technical read, but I think it's very applicable to the world in which we live in, especially when it comes to auto lending and in general the automotive industry given the current supply constraint. What are your thoughts on how do you balance the standardizing the processes, but keep an eye out for AI? What's a checklist that will be helpful for the people on the line to think about?
Well, that's a good question. I going back to your comment, I do think having a good policy and procedure, or policy and process as a part of your overall compliance management system, where you're doing things the same way each and every time. You have a standard policy, a standard process. I think that is something that is particularly in the Chopra era, is vitally important for folks to have. In terms of like a checklist for AI, well, I'd have to probably refer folks to, usually I refer folks to one or two of my partners, Gene Noonan and Becky Kuhn, for that, just because it is so technical and it is so specialized when you're talking about using these algorithms and using AI to make these credit determinations. It's just something that it's certainly not something to dabble with, and so usually there's almost like different layers of that, and usually I refer to folks to my partners Gene or Becky for those types of issues.
So do me a favor, Eric, let's put a pin on this, but if you don't mind sharing with me the contact information when I circulate the video and the link to the registration, this way we can put that information, because I personally have people stopping me at conferences asking me about it. Like, I'm not the best person, but I know that the topic is becoming emergent, so it would be good to have a contact person if people have questions. Thank you.
Yeah, you bet, we'll do. I know Gene's been looking at fair lending issues for a long time, and as has Becky. Becky's was formerly a part of the FTC, so she's got that angle as well to look at it. But it's something, boy, it's just so highly specialized that you really just have to get somebody that's got a lot of experience in that area. But I know, like I said, I know it's something the Bureau is very, very interested in, and they're going to, I think they talked about it again today, and I'll talk about that later, but the use of AI is something they are going to be focused in on for quite a while.
You want to move on to the next topic, or somebody has questions? Let's see if anybody has questions on this topic so far. Going once, going twice. This is the time for you to get the sip of water before we make you speak for another 10 minutes.
Get the deep breath of oxygen. There we go.
Thank you, Eric.
All right, so the next topic, the compliance bulletin on negative reviews. I won't spend a ton of time on this, but it is interesting, and you'll see how the take a look down below at the FTC litigation updates, the negative consumer reviews. This is one example again of how, with Chopra coming over from the FTC to be the new director of the CFPB, the Bureau and the FTC are working together like they never have before. Yeah, they've had memorandums of understanding together for a long time, a couple different iterations of that, but they are working hand in hand on some of their activities. In this case, compliance bulletin on negative reviews, and then with the FTC, they actually went after somebody for what they were doing on some different consumer reviews that we'll talk about. But on this bulletin, they issued a bulletin that's already effective as of March 28th. But the bulletin talks about the Consumer Review Fairness Act of 2016 that basically protects covered communications, protects these consumer reviews that a consumer may give. And this new policy highlights that practices such as posting fake reviews or inserting clause in a form contract with a consumer that forbids a customer from publishing an honest review may violate the Consumer Financial Protection Act. This guidance document talks about certain practices that are generally unlawful under that CFPA, including those contractual gag clauses. Again, having a form contract, basically it's a contract that has a standardized term that is used by a person in the course of selling or leasing that entities or persons goods or services, that basically stops a consumer from posting an honest review Okay, if that's the case, then that could be a UDAAP, unfair and deceptive act or practice. Or maybe having fake reviews in a way that appear to be independent from the company, but really, you know, it bumps up their rating. They're getting all these 5-star reviews, but they're not legitimate reviews. That too can be a UDAAP. Or where the company may limit or manipulate those negative reviews in such a way that you know could be used to trick a consumer. Maybe a consumer has, you know, a few 1 or 2-star reviews, but the company really pushes those down in such a way that maybe they're not on the main page, they're like 10 pages down the road, and you don't see those. And so it could be used to trick a consumer. So those are all examples of what they consider an unlawful practice under that law. And again, I think this effort is related to the FTC's efforts on the negative consumer reviews, this Fashion Nova case that we'll talk about in just a bit. So if you do permit customer reviews, make sure that your practices comply with all applicable laws, including this this new bulletin from the FTC or from the CFPB rather.
Now, Eric, can I ask you, because I'm actually curious, because I think for local businesses, it's very easy to leave a review, say on Google or whatever else, right? But for national finance companies, that's not that easy, right? There's not the same mechanism. So when they say reviews, what are the things that actually the CFPB is looking at? Do they really go on somebody's local, you know, branch and they look at how many 5 stars versus 1 stars, or what is it that they're looking at? What are the things that people on this call should be keeping in mind as things that they need to look at?
Yeah, I mean, really, you're talking about, you know, that company, or I suppose it could be a branch, looking at, you know, just a consumer inputted review of that company's goods or services that they, you know, goods that they sell or provide, or the services that they are providing. I will say that, I mean, I can't say that I've seen really any finance company, like an auto finance company, have a, you know, a review portion of their website where a consumer could put in a consumer review. I think it's more focused on like a company's website than say like, you know, like a consumer gripe site, for example. The example that close example I can compare it to is like in the FTC's case, where there was a company called Fashion Nova that if you go on there, it's I guess a fashion forward company for different clothing items. And you can actually go to like a particular item, like a blouse or something on the website, and you can see consumers that will put in a review of that particular good, that particular item. And you can, and folks can rate the item, say 1 to 5 stars. That I think is what they're talking about, is these consumer provided reviews on a company or institution's website. And I guess in the Fashion Nova case, Fashion Nova, it was claimed that they were manipulating these views. So you didn't see the less than 5-star reviews. You were seeing only the, you know, the top reviews. You weren't seeing the negative reviews. And so it really, at least they argued that it really confused the customers or was deceptive to consumers, because you weren't seeing the true reviews that other consumers were leaving on a good or product.
Thank you.
Good question, though. Any other questions? Okay. Well, let me go on to junk fees then. And this is something you probably heard about, but I mean, talk about a weighted term, junk fees. I mean, the Bureau really, I think, telling us what they think about the term. Back in January of this year, the Bureau launched a initiative that they were going to save consumers money on junk fees. And what they tout and they call like overdraft fees. That's a big item for them. Is, you know, somebody paying an overdraft fee, they consider it a junk fee, or like a credit card late fee, or NSF fees. All of these types of fees that a consumer may be a surprise to consumer, like if they pay late. The Bureau claims that these are surprising to a consumer, that they're getting a late fee, or if they bounce a check, that they're getting an NSF fee. they claim that, these are types of fees that really a consumer can't go out and shop for. They're kind of stuck with those fees because they're doing business with the company. They claim that they're kind of stuck with it. Well, the Bureau put out this initiative. They sent out a request for information asking the public about these types of fees, like a fee that seemed too high for the service or fees without a clear basis. And in March, the Bureau announced that they had received over 25,000 comments on their request for information. And so they decided they were going to extend out the comment period to middle of April or so. They wanted to hear from stakeholders and small business owners about fees that people believe were covered by the baseline price of a product or service, or unexpected fees for a product or service. Again, fees that seemed too high, or fees where it was unclear why they were charged. So the jury's really still out on what the Bureau is going to do with all this information. But it's pretty clear that they don't like these types of fees, overdraft fees, late fees, NSF fees. And so stay tuned. That's not the last we'll have heard from the Bureau on junk fees, but I know it's something they're actively looking at. Any questions on that before I move on?
Before you move on to this, because I think the next one will be state law updates, right? So if you don't mind, I'll ask you one more question, trying to pull him back up one level here. Like Chopra's background is really on student loans. So I think a lot of us had the expectation there will be a lot of oversight on student loans. But where do you think automotive stacks into the list of priorities? And then, I think I've seen, maybe it's me because I have a biased view and I don't see all the activities from the CFPB, but it seems to me they've been more active in the last 2 or 3 months than the previous year. So where do you think that this is going?
Yeah, good question. And I do have a couple of CFPB updates before we get to like the state law updates. So, but I think, I'm with you. I think the traditional mindset was that, well, he's probably going to go after student lending first. And that was what we were all thinking. But you're right, the last, I'd say 3 or 4 months, they've been extremely active as it relates to, auto finance areas, particularly these so-called illegal repossessions, the junk fees, which I think also cover some of the auto finance fees that are charged. They've been real active. So I think as between, student loan lending and auto finance, I would put auto finance now ahead of student lending. What Chopra has said, and this kind of goes into my next update about reining in repeat offenders and owner and senior executive liability. I think what their first thing that they are going to do, and what they've been doing really, is he said, look, I'm tired of these big, extremely large companies getting hit by a fine, getting somebody claiming, like the Bureau claiming that they've done bad things, that they get a consent order. But Chopra said, I think these companies that are extremely large like that are getting hit with these fines, but they see it as basically a cost of doing business, and they don't change their behavior. They pay the fine and they go on doing the same things that they had been doing. So what he wants to do is he wants to go after these repeat offenders, so-called repeat offenders, and particularly those that are under a consent order. He wants to go after them again for any subsequent violations where maybe they didn't follow the terms of the original consent order. He wants to go after them again, knowing that this could lead to more and more litigation, possibly. He also wants to go after, I think, not only the business itself, but also the owner or owners of a business, as well as, say, the senior executives or senior management of a company. And they've done that. Particularly, there was a case that they brought against TransUnion recently, where they alleged that TransUnion had violated the terms of a prior consent order, but they also brought in a former senior executive. So I think that is the trends that I'm seeing. Is it seems to be more active, more focused on auto finance, particularly as they see the used car prices going up. And what I think it's just in the Bureau's head that they think that since the used car prices are going up, that this is just going to naturally lead to a bank or finance company just throwing out their CMS and how they traditionally handle repos, so they can go out and repossess these vehicles and then get them sold and reap all these profits. They've just got that in their minds for some reason. That's one thing. And then I think also going after repeat offenders and then senior executives at the various companies. Does that answer your question?
Yeah, and I am observing, at least on the dealership side, right? I'm observing also that the size of the fines has grown so dramatically. I think I've read back-to-back press releases from the CFPB and the FTC on, oh, here's a new record fine, followed by 3 weeks later, oh, here's a new record fine. So I don't want to put you on the spot here, but any predictions that you want to make on what is it that you can expect? And again, for this audience, what is the best way to minimize risk?
Right. Yeah, I mean, as far as predictions, I do take them at their word that they're going to go after repeat offenders. So if someone's company is subject to a consent order, I mean, the Bureau's coming back. They are going to be looking at you very hard, particularly if you are a larger institution. I think that's one thing that they will do. I do think that we will see continued interest by the Bureau on illegal repos, folks reportedly charging fees for somebody that had the vehicle repossessed to get their personal property back. I don't think we've heard the last of that. I mean, the Bureau's been touting that since 2016, but it seems like that activity has really, the chatter has certainly picked up the last few months. And I think we're going to see continued interest on those areas as well. I think the best thing that folks can do to really shore things up is to get a strong compliance management system in place. I think having strong policies and procedures, and not only just on paper, but following through, making sure that you are doing what you say you're doing in your CMS. What's that?
I think it was just a glitch.
Oh, okay. But yeah, I mean, I think, it's one thing to have a strong and robust written CMS, but also to monitor to your CMS, to audit to your CMS. I mean, that's what the Bureau is going to be doing. When you look at their examination manual, I mean, that's what they come and look at as let's look at the strength of your CMS. But to me, that's the best way to protect yourself, is having a strong CMS in place, and then, taking these compliance bulletins, these advisory statements that they are issuing. Chopra has said that another thing that they want to do is they really want to come out and provide a lot more of their guidance documents, advisory opinions, compliance bulletins, policy statements. And so, I think those can be helpful. Taking a look at those and what others are being tagged with or allegedly to have done under, either a consent order or a supervisory highlights, looking at what the Bureau is finding and making sure that you are not doing those things. It takes a little bit of digging to look into those, but basically just learning from others' mistakes, I think, is the biggest thing that you could do.
Thank you, Eric. And you said you had another update on CFPB before you move to state laws?
Yeah. I think one thing, we talked about the repeat offenders, supervision on non-bank finance companies. The Bureau announced that this was at the end of April, that they have this, it's a largely unused legal provision where they can actually examine non-bank financial companies that pose risk to consumer. It's been a long dormant authority that they have. Basically, we're talking about fintechs, I think, for the most part, but it's someone that is engaged in, consumer financial services with consumers. Maybe they are not one of the entities that is listed as being specifically subject to examination by the Bureau, or maybe is not a larger participant under the Bureau's larger participant rules. But those types of entities could still be subject to being examined by the CFPB under this kind of dormant authority. They've issued a procedural rule going all the way back to 2013. And this announcement, they also issued that they are going to, they've issued another procedural process about how they would go about finding somebody that is engaged in risk or potential harm to consumer, and they would actually put them on notice that they might be supervising these non-bank financial companies. So again, another expansion, I think, of their authority, although they've had this authority since Dodd-Frank was put into law, they just really have never exercised it. So that's another big change, I think, from the Bureau.
I found it interesting that as the safeguard rule has been modified, and now December 9th, there's going to be this new definition of who is subject to liability, right? So now you're going to have marketplaces will be subject to it, the fintechs will be subject to it. So this is yet another one of those things where it's interesting to observe that the FTC and the CFPB are moving into lockstep on expanding the scope and expanding the depth of what goes under scrutiny.
Yeah, exactly right. I mean, they are working, they used to be like big brother, little brother, where they were, they were fighting to be the, the consumer protection, agency in the 21st century, where they were really fighting with each other to be the lead on the big consumer protector. But now, I mean, since Chopra has come on board, they really are working pretty well in tandem with each other on these, negative consumer review, these illegal junk fees. I mean, the Bureau is using the term junk fee, but so is the FTC now. So they are really working hand in hand. So you really can't watch one, I don't think, without watching the other to see what they're doing and see, where they're headed. To watch one is you really need to watch the other. So one other quick update. The Bureau today just issued another advisory opinion on Equal Credit Opportunity Act. They basically issued this to affirm that the ECOA bars lenders from discriminating against consumers after they have received a loan, or I'll just say extension of credit, and not just during the application process. Well, okay, yeah, this is, I mean, appreciate them affirming that. That's been the rule for forever. But they did say, this goes back to them saying that they're going to start issuing more of these advisory opinions, additional guidance documents to help entities understand their obligations under the law. And that's what today's, I think, advisory opinion is out there to do, is just to confirm for folks, this is what the law is, and this is what we are making clear, or trying to make clear, that, about these different protections that a consumer is protected, not just at the initial extension of credit, but really through the life of the obligation as well, during the servicing, collection, repossession of a vehicle. The ECOA and Reg B that implements ECOA apply through that whole process. So interesting, but again, it's the law. By them issuing this advisory opinion, you'll note too that many times when they issue these bulletins, these advisory opinions, they've usually got something in the works with either like some sort of supervisory action that they're taking, where they notice something that they wanted to call out to everybody, or there might be an enforcement action on the heels of this. Sometimes those work, in tandem with each other. So I wouldn't be surprised to see some sort of enforcement action or something in their next highlights that deals with ECOA during the servicing or collection of an account as well.
I know we have just 7 minutes left, Eric.
Okay.
Oh, there was a question?
Oh, sorry, it's Keely. Hey, Eric, it's Keely Smith with Auto IMS. I just had a quick question or an observation.
Sure.
You know, when companies are getting fined, and especially you were just mentioning how the CFPB is making certain assumptions about how people conduct business and that there's going to be all these profits because cars cost more and they don't really understand how slim the margins are in the repossession business. But are you finding companies are just saying, you know what, it's not worth fighting this. I'm just going to suck it up and pay it, versus really saying, yeah, UDAAP is so general. Where's the evidence exactly? Show me numbers about how you came up with your decision. Or people or the companies, I paid attention to the fines, but I'm not always paying attention to all the outcome.
Right. Yeah, great question. And I suppose it depends on, company's exact situation. The ones that I see, or at least ones that we are handling at our firm and our government investigations practice group, are the companies that have decided, you know what, we're going to fight it. And, there is obviously a point where it makes more sense to settle the thing than to keep fighting it, because anytime you're fighting the government and they can print money, that's real difficult to fight somebody like that that's printing their own money. And the fines are so steep when you look at the CFPB fines that they can impose, particularly if it's a knowing violation. What is it, 1.5 or 1.6 million per occurrence. So it's extremely large in some of these fines that they could throw at you. So it just depends on, I'd say it depends on the facts of the given case and how much a company really wants to dig their heels in and fight it.
Great.
But I know there are some cases where folks just say, it just, we know we're going to have to pay, but let's see how many zeros we can take away from the check we may have to write, what we can live with, because it's either you pay the government or you pay, folks to have to defend it for you.
Exactly. Okay, great. Thank you. That's helpful.
Eric, I think now we're down to the last 3 or 4 minutes. Do you think you have time to do a quick state law update, or do we need to keep it for some other time?
Yeah, well, on the state law updates, I tended to focus more on the FTC and CFPB. I think the state law updates, and I can just tell you real quickly from what I'm seeing, it's been fairly quiet, I guess, on the state law updates. I think the biggest thing that I've seen trend-wise is that, the states are starting to promulgate these new privacy law acts, like, the new California Privacy Act. I think Virginia, I guess, has a new privacy law. I think Colorado, another state, I want to say Utah was another one.
Utah, yes.
Yeah, there's like 8 or 9 states that have different privacy laws kind of in the works, but right now that seems to be the big trend. I don't know that everybody's going to go as far as what California did, but there seems to be different, variations of the different privacy laws that, God, just it's yet again, it's hard to comply with those laws because you're going to have all these different variations of them. But that seems to be a big trend at the state law level right now. So other than that, it's fairly quiet, I guess, on the state law, at least not that I've seen anything big pop up here recently.
And one last question, unless somebody has another one. Come the November election, which seems far, but it's around the corner, do you think that they would change anything in the trends that you're observing the last few months with the CFPB and the FTC?
That's a good question. I suppose it might, but the problem is that, Chopra serves at the whim of the president. He's in there for a 5-year term. And so unless the administration says, I'm tired of Chopra being there, because he can be fired at will, basically. No matter what happens in the Senate, no matter what happens in the House elections, he's there for as long as the president wants him there. Now, I could see if the Republicans get both the House and the Senate, or maybe, you know, one or the other, maybe he's called to the Hill a lot more to testify. That would be the only, you know, thing that I suppose could happen. Maybe they could apply some pressure on him to do things, but, you know, pressure has been applied before. Look what happened to Cordray, and he kept with the mission. He kept doing what he wanted to do with the director with pretty much, you know, ultimate authority. So I would say probably not a big change, no matter what happens this November.
Well, Eric, I want to thank you for the time. I put your contact information up here on the screen, but it's ejohnson@hudco.com. As I said before, when I share the link, I'll make sure I send a follow-up email to everybody. And Eric, if you don't mind giving me the information on Gene and Becky for the AI, I think that's a topic where at least some of our audience will be interested in. I've taken a lot out of this conversation, but I think a good thing is that the people here in this call are really interested in compliance. There's a lot of things IARA is doing. Of course, you know, we have people like you that volunteer their time to make us smarter about the space. So again, I'm super grateful for your time and really for everybody else that attended the call. Thank you again, Eric.
You bet. Thanks for having me. I really enjoyed it.
Thank you, Eric.
Everybody.
Thank you all. Take care.